Hello, everyone. My name is Anurag, and on behalf of Indo-American Chamber of Commerce, I welcome you all to this virtual seminar. Today's topic is impact of India tax changes on NRIs like us. Many of you have joined from different parts of the globe, and I thank you all from the bottom of my heart. These are trying times, and I urge you all to stay safe. Who would have thought that this pandemic will really change the way we live now, just a few days ago? My enriching association with the Chamber began in the fall of 2016. At that time, as a co-founder of iValley Innovation, a fintech incubator, I was deep into organizing meetups, hackathons, fintech conferences, and everything in between. Fast forward, the board last year found me qualified enough and made me a board member. So here I am now as a board member, your MC for today's event. Before we start the event, I will quickly go over today's format. We will begin with a very brief introduction and then dive straight into our presentation of the day. That will be followed by about 15 to 20 minutes question and answer Q&A session. We will then end with a very short closing remark. Now for the Q&A session, some of you have sent in your questions and our experts will answer them. And for the rest of you who are attending today's seminar, if you have any questions, please direct them to Geeta. Geeta is the Geeta Ramakrishnan. You can find her in the chat box as ICAISF admin, and you can privately send her your questions. And then Geeta will then moderate, and she will forward them to our experts as we go forward. So let me straight dive into this today's presentation introduction. I would like to introduce Atma Dayal. He is the president of our chamber, Indo-American Chamber of Commerce. So here I'm presenting Sri Atma Dayal in front of you, and Mr. Atma Dayal will tell something about the chamber and our activities to all of us. Mr. Atma Dayal, the mic is yours.
So I want to welcome everyone who's joined in to this webinar. And again, thank you for attending. And I just wanted to say that the Chamber has been doing these events for several years, and we do at least 6 to 8 per year, but it looks like this year we might do more of the webinars. So we're living in very kind of different times with the COVID-19 and shelter in place, especially here in California and many counties. So this is kind of the way things are being conducted right now. The Chamber has been around for over 20 years and has been very active. And we would like to have people join the Chamber if they like what we are presenting, and we will be having another event later this month. It will be on telemedicine. And these first 2 events we typically have are on taxations. And we want to thank Dr. Ahuja for agreeing to join and participate and give his input on the new tax changes. And maybe he can also shed some light on the new stimulus package that India has put out. At least we're hearing some of it, not all of the details. Having said that, I'd like to again say thank you, and we hope to see you on our next webinar. You will be receiving emails from us kind of detailing when the next one is going to be. Having said that, I will send it back to Anurag to move it forward. Again, thank you.
Thank you, Atmaji, for telling about Indo-American Chamber of Commerce and the activities that we do. As you all know, today's event has been organized by Indo-American Chamber of Commerce and San Francisco chapter of the Institute of Chartered Accountants of India. Our speaker of the day is tax luminary and author Dr. Girish Ahuja. Dr. Ahuja will be supported by Neeraj Bhatia from Bhatia and Company. Dr. Girish Ahuja is a well-known authority on taxation in India who has been practicing as a chartered accountant for nearly 50 years, PhD from Faculty of Management Studies. Dr. Ahuja was nominated by the Government of India as a member of Task Force for redrafting the Indian Income Tax Act, a report of which was submitted to the Finance Minister in August 2019. He has also been nominated by Government of India as Independent Director to the Board of State Bank of India as well as Unitech Limited. He has authored over 25 books on direct taxes for students and professionals. Hear from him. Hear from a veteran who has delivered over 3,200 lectures worldwide on the issue of direct taxes and who has drawn packed audiences during his presentation on union budget. Neeraj is an accomplished accounting professional with 35 plus years expertise in international and domestic tax planning, accounting, compliance for startups and multinational entities. I just want to introduce and hand over the mic to Geeta Ramakrishnan. Geeta Ramakrishnan is the founder member of the San Francisco chapter of Institute of Chartered Accountants of India, and she is also the current chairman. Geeta, here you go.
Thank you. Ladies and gentlemen, a very warm welcome. Thank you for joining us today. My name is Geeta, and I'm the chairperson of the Institute of Chartered Accountants of India, the San Francisco chapter. I know that the Institute probably needs no introduction in a forum such as this, but for those of you who may not be familiar with what we do, the Institute is the preeminent finance and accounting body of India, founded by Parliament. We like to think of ourselves as a partner in nation building. Aside from, of course, the accounting standards and the auditing standards and the partnering with the government that we do on national tax policies and so on. Today, the footsteps of the Institute is all over the world, as you know. There's more than 250,000 chartered accountants all over, many of them, of course, in India, but many more also outside of India. And the San Francisco chapter is one of over 30 chapters or overseas branches of the Institute. Our purpose is to bring together all chartered accountants here in the US to promote the cause of knowledge development, of professional development. So towards this end, we hold events every month. Some of them are professional in nature, but some others are of general interest, business, things happening in society, just things of general interest. These events are open to the public many times. We invite you to our LinkedIn page, ICAI San Francisco, or our Twitter handle at ICAI SFO, or indeed our website at icaisfo.org to see, to get an idea of what these events are like and to find out when these events are. We would love the opportunity to have you join us. I see today people from all across the world, just I think Anurag mentioned that. A special welcome to all of you. I see Basant Kumar Dugar, founding chairman from Thailand. A shout out to you. And with that, I think I'll just hand it over to the star chartered accountants of today. Take it away. Thank you.
Good evening, everyone. It's good evening, good morning, and good afternoon, depending upon where in which part of the world you are. Hope you all are staying safe and taking all precautions for yourself and your loved ones in this crisis situation. You must have read the profile of Dr. Ahuja. He actually doesn't need an introduction. He's one of the senior most chartered accountants of India. He was my professor in Shriram College for 2 years, actually. Many of you, many of you must have read his books on costing and direct taxes and also. We'll turn to Dr. Ahuja. So our first topic we want to talk about is we want to ask your views on residential status. We hear a lot of changes have taken place. First, we were hearing that the Indian laws have been changed regarding residential status. They have been wanting to tax the stateless citizens. But then later on, we heard there are some changes when the final Finance Act was passed. So let's hear your views on that.
Thank you. Good evening to all in the US, and of course, good morning to the persons who have joined from India. The president of the Indo-American Chamber of Commerce, Atma Dayalji, chairperson of the San Francisco chapter of the Institute of Chartered Accountants of India, Geeta Ramakrishnan ji, Anurag Singh ji, the host for today's function. Bhatia's brothers, of course, Neeraj Bhatia is from California, and Mr. Suraj Bhatia is from Delhi. He's also joined the program today. Well, Manjul Batraji, yes, of course, senior to me. I should welcome, and she's the only chartered accountant to say it those days. Very good. And she also the ED, I'm told, of the Indian American Chamber of Commerce. Well, the gentleman from Thailand, you also mentioned Mr. Dugar is also there. And from India, I have Suraj Bhatia ji, of course, advocate Mr. Sanjay Sharma ji, and Arunika happens to be my student, of course. She is also there, joined from Delhi. So ladies and gentlemen, let me first tell you that we have followed the footstep of US in regard to residential status. Let me tell you what is this. I remember when this bill was presented, finance bill is presented, when presented by Madam Sita Raman on 1st of February. And I was delivering a lecture on webinar from Institute of Chartered Accountant premises. And at that particular time, when I was delivering that lecture relating to residential status, we got about 400 queries from UAE particularly. Different places. Sir, what is this? What kind of a law you have made? What kind of a thing it is like that? Why they said what kind of a law you have made? Because I redrafted the income tax law of the country, which is yet to be take a light of the day, but still we have redrafted it, given to the finance minister. So that, what have you done? I said, don't worry, I'll come over, because I was supposed to go to Dubai, Muscat, also Kuwait and other places. I told them I'll come. I went there. They were really engaged. So what kind of a law is this you have made? And we will all be put into difficulties. I told them there is nothing to worry, but still they were not agreed to take a tax residency certificate of that country. And there were a lot of other problems. I came back, had a good discussion with the CBDT chairman, and he was very kind enough to give me an appointment, and we discussed at length. And let me tell you, at one time, the finance minister was my student only. Mr. Neeraj Bhatia knows he's also from Shriram College of Commerce, and Mr. Jaitley was also from Shriram College of Commerce. So he used to listen to me, and that's why everybody knew me and came back, and the law is wholly changed. Now I'm coming to the new law. You will have to give me a little time to make you understand, because you are not or you don't remember now the law of India. But let me come back to that. We have Section 6 of the Income Tax Act, which talks about Section 1. It talks about an individual is said to be resident in India in the previous year if he has been in India for a period or periods amounting to all 182 days in the relevant previous year. So if you are in India for 182 days, you are citizen, you are non-citizen, you are foreigner, doesn't make any difference. You are a resident in India. But if you don't satisfy the first condition, then we go to the second condition, that in the 4 preceding previous year, immediately preceding the relevant previous year, he should have been in India for 365 days or more, and in the relevant previous year, just for 60 days or more. You were supposed to satisfy both the conditions. 60 days in the current year and 365 365 days in the 4 preceding previous year. In US is a different thing, 31 days and total 3 years, you know that 183 days, I'll come to that. But here, 60 days in the current year and 365 days in the 4 preceding previous year, you become resident. But then I remember we had given a concession, there was an explanation that if you leave India in any previous year for employment abroad, this 60 days will be substituted by 182 days, meaning thereby you could live in India for 181 days and then leave India for employment. You are not taken as a resident. You could live for 181 days, and the moment you are here for 182 days, everybody is a resident. So that concession was there. But the second concession is more important for all of you. Please listen to me carefully. What was the law earlier and what is the law which has been changed? Earlier the law was, it was a clause B in explanation. The law said, in case of a citizen of India or a person of Indian origin, many of you are either citizen of India or person of Indian origin, means you have taken up the citizenship of that country. You are person of Indian origin. Person of Indian origin, we call it as either he or his parents or his what you call grandparents must have been born in undivided India, that in before 1947. Either he himself was born, as I was born, Madam Batra was also born before 1947. So she is, even if she is a citizen of US now, she will be treated, if she's, I don't know, she will be treated as person of Indian origin. But if I was born after 47, then father should have born before 47. Or if father was also born after 47, grandfather must have born before 47, then you are taking it as person of Indian origin. The law is now, in case of a citizen of India or person of Indian origin who is outside India, comes to India for a visit. He comes to India for a visit. The period of 60 days in condition number 2 shall be substituted by 182 days. Meaning thereby, he could come to India for 181 days without being called resident in India. 181 days in the previous year. We have previous year, April to March. You may be having calendar year, April to March. So if you are during the previous year, April to March for 181 days, you are not treated as resident in India. Rather, you could come for 362 days at a stretch, provided you come somewhere in October and leave somewhere in September next year. September next year. Why? Because 181 days in 1 year, 181 days in the next year, you could stay here for 362 days also, without being called resident of India. You know, what is the disadvantage of resident? You have to pay tax on global income. That is the only disadvantage. When you are a non-resident, you have to pay tax only on Indian income. That is the only difference. But look, come back. 182 days. It was not 182 days at one particular time. It was only 60 days. I remember Mr. Savraj Paul, during that time, had shifted to UK. And he said to Madam Gandhi, because Madam Gandhi was taken as the sister of Savraj Paul those days, he asked Mrs. Gandhi that, look here, I am now shifted to US, I'm there, but I would like to come to India and do some work here also, or do some business here also. But I cannot stay here for more than 59 days, because the moment I'm here for 60 days, I'll become resident. And the moment I become resident, I will have to pay tax on the global income. That was the reason. Then she raised 60 days to 90 days. And gradually 90 days were raised to 150 days, and ultimately it was raised to 182 days. That means you could come to India for 181 days without being called a resident. Now, what is the change? This has been, explanation has been extended. I'll explain both the explanation or combined. In case of a citizen of India or a person of Indian origin who is outside India, comes to India for a visit, the period of 60 days in condition number 2, which I told you, shall be substituted by 182 days. That is still there. But it is also extended. And in case of a citizen, this is a new amendment, and in case of a citizen of India or a person of Indian origin who is outside India, whose total income, excluding the income from foreign source, exceeds 15 lakh, the period of 60 days shall be substituted by 120 days. Please note 120 days. What I'm saying, you are outside India, you are a citizen of India, or you are a person of Indian origin. You want for a visit to India, come and visit. But look here, if your total income, excluding income from foreign source, exceeds 15 lakh, exceeds 15 lakh, 1.5, then you can come and stay in India only for 19 days to be called non-resident. The moment you are for 120 days, you will be called resident of India. 119 days instead of 181 days. Please, what is this 15 lakh? Indian income, that is income received in India, deemed to be received in India, income accrue or rise in India, deemed to accrue Indian income, plus 2 foreign income. Please, plus 2 foreign income. One, income of a business which is outside India, but it is controlled from India. Whose business? Sole proprietary business, individual's business, not company. Income from a business outside India, which is controlled from India, or income of a profession outside India, which is set up in India. Now, Neeraj Bhatia is having profession there. That is a different thing. If he had set up the profession in India and was doing some work outside India, then it is income from a profession which is set up in India. You take a certificate of practice of Institute of Chartered Accountant of India. That means you are established, you are practicing in India, but you may take up the work outside India. Then in that case, you have to take that income also, foreign income also. So 15 lakh will include Indian income plus 2 foreign income only 2 foreign income, no salary income, no house property income, no business also profession income. If you are having it only outside India, nothing to do in India. But if there is a business which is outside India, but controlled from India, or a profession which is outside India, but set up in India, then you will take that income also. And if that exceeds 15 lakh, then you can come to India only for 119 days. 119 days. The moment you are here for 120 days, you become resident. Don't worry, don't become. If you are resident, how does it matter? Because we have tiebreaker rule also with the Indo-US treaty. There is absolutely nothing to worry. But wait here. They have said you can come to India even for more than 120 days and 181 days also. You can come to India for 121 to 181 days. But in that case, you will become resident, but not ordinary resident. We have a concept called resident and ordinarily resident, and we have a concept called resident but not ordinary resident. What is the difference between two concepts? Let me tell you. In case of a resident in India, the individual has to pay tax on the global income, even the tax or income on foreign country also, wherever earned. Wait a minute. And in case of a non-resident, you have to pay tax only on Indian income, plus not, I said non-resident only Indian income, but not ordinary resident. You have to pay tax on Indian income plus 2 foreign income. One, income of business outside India but controlled from India, or income of profession outside India but set up in India. You include that, and if it exceeds 15 lakh, then you become not ordinary resident. Don't worry, but you will pay tax only on Indian income and these 2 income. You don't have to pay tax on foreign income. This is one. I don't want to take you to 61A. There is another concept which has been introduced in India. Let me explain to you. Because you also have a concept now. If you are a citizen of US or you have holding a green card of US, you always become, you have to pay tax on the global income in US. You know that. Citizen of US or a holder of a green card of US or even a resident has to pay tax on the global income. It's a different story that whatever tax you have paid in the foreign country, you get credit for that. That is a different story. But in any case, that is the law in this or your country. But your country means US, because your country is also India. It's not that your country is not India. We always welcome you in India. So there is nothing to say your country in US, I will say. Coming back. Now, what they have done. If you are not liable to pay tax in foreign country, let's say you are in Bermuda you are in Bahama, you are in what you call UAE, you are in Kuwait, you are in Bahrain, or you are in, let's say, Muscat, there is no liability to pay tax, no tax. And if your total income in India exceeds 15 lakh, total income. Somebody has raised a question, will total income include non-resident external account interest? Sir, that is exempt. We don't take in total income the exempt income. So if there is an interest on non-resident external account, which is exempt in case of all non-resident, let me tell you, that is not to be included in the total income. Whatever exempt income is there, not to be included. But suppose this person in UAE or in Dubai, his total income in India is 15 lakh, including those two sources, 15 lakh. Then he will be deemed to be resident in India. Please note the word, deemed to be resident in India, even if he does not come to India for one day. Even if he does not come to India for one day, he will be deemed to be resident in India. Mr. Bhatia pointed out stateless persons, but it is not stateless. Even those countries, if you are there in Cayman Island, you are in Cayman Island, you are in Dubai, you are in Kuwait, you are in Bermuda, you are in Bahama, there is no tax. So if you have a total income in India more than 15 lakh taxable income, you will be deemed to be resident in India, come what may, whether you come to India for a day or even for one day, or you don't come at all. But what will happen? Nothing. You have to pay tax on Indian income, plus you have to pay tax on a business which is outside India but controlled from India, or a profession which is outside India but set up. That's all. That's all the change. That's Indian income, so you are also paying the tax. But wait now. I again come back to you after explaining to you. Suppose you become resident in India because you come to India for 120 days, or maybe 120 days to 181 days. I told you will become not ordinary resident. But if you come to India for 182 days, you will become resident. Doesn't matter. We have a treaty with Indo-US treaty. In case of Indo-US treaty, you can become resident in two countries. You may be a resident of US also, and you may be a resident of India also, because you came to India for 120 days, you become not ordinary resident, or you come to India for 182 days, 2 days, you become resident. Then we look into the treaty. When you are a resident of both the country, we have to apply tiebreaker rule. Let me explain this tiebreaker rule in a simplified manner. You know, India won the match from New Zealand recently in T20. There was a match which was tied. 2 matches were tied. And what do you do in 2 matches when there is tied? You play a super over. And whichever team scores the maximum is treated as winner, declared as winner. But by chance, if the super over also, you score the same runs, then again super over is played. You keep on playing the super over till one team becomes the winner by having more runs in that over. Similarly, we have a tiebreaker rule with all treaties, even US also. In a tiebreaker rule, if you are resident of both the countries, we will always see where you have a permanent home. If you have a permanent home in US, then you will become non-resident of India. And if you have a permanent home in both the countries, as well as US, as well as in India, then we go for again there is a tie. We go for another tiebreaker rule. The another tiebreaker rule is where you have an economic interest or your vested interest, a personal interest, economic interest or vested interest. If you have a more economic or vested interest in US, you become non-resident, although you were resident, but you will become non-resident. But again, this is treaty. This is treaty. Again, if you cannot, you have permanent of both the countries and you cannot determine vested interest, then the third tiebreaker is where you have habitual abode. Habitual abode. If your habitual abode is US, then you are non-resident of India. If your habitual abode is India, you are non-resident of US. But wait, even if you are non-resident of US law says pay tax on the global income. That is a different thing. US says pay tax on the global income. But we will say, no, look here, you have become non-resident. Okay, we will give you some concessions also once you become non-resident. Another tiebreaker, if that also is not finished, then of which country you are national. If you are a national of India, you will become resident of India. If you are a national of that, you will become non-resident. This is for treaty, you become non-resident. But wait, even if treaty you become non-resident US, that US says you will have to pay tax on the global income because you are citizen of US or you are holding a green card of US. That is a different story altogether for US. But for us, if you are there, if you are treated as resident of US, we will declare you on the tiebreaker non-resident of US, a non-resident of India, you will get many advantages. This is the one which I wanted to tell. So even if you become resident here or resident but not ordinary resident by coming to India for more than 120 days, but not more than 181 days, you become resident but not ordinary. But you are here for 182 days, you become resident and ordinary resident. Difference. Please remember the difference. Please. If you are declared resident, you have to give the details of your foreign income and foreign assets also in your return of income. In your return of income. So nobody wants to become resident in the sense, because the moment you have to give the details of the foreign income, many questions may be asked, the sources and everything, or you may have created a trust outside India or some other signatory power. So people don't want to become resident of India. But if you become not ordinary resident in India, you do not have to give the detail in Indian return of income, your assets of foreign country. You don't have to give assets of foreign country or income of the foreign country. But wait, in US, there is FATCA, and FATCA says we will have to give, you have to get the information from they can take information from all the countries. India is also passing on the information, exchange of information in FATCA, which is US. US is more strict. India is more liberal, let me tell you. They are taking into consideration everything. And you know the maximum rate of tax in US for individual federal income tax is 37%, if I'm not wrong. Yes. Starts from 10%, of course, 10, 12, 22, 24, 30, 35, 37. But then you may have state tax also, state income tax also. Right. You may have even local authority, municipal tax also. We don't have that many taxes in India. You only have to pay tax, maximum marginal rate 30%. But unfortunately, due to surcharge, which is recently increased, and that has grossed little more. But then your income should be more than 5 crore. Then it goes beyond it. Otherwise, if your income is up to 1 crore, it is only 31.2%, including education cess. If you have more, because 10% surcharge, 50 lakh, up to 50 lakh, 31.2%. If you cross 50 and 1 crore, then it is 34 point something, 34.2. If you cross 1 crore, then the surcharge is 25%, 15%. If you cross 22 crore, surcharge is 25%. If you cross 5 crore, then the surcharge is 30%. It's a cumbersome thing. I never wanted to give you that trouble of remembering that. But at the same time, the maximum marginal rate in our country is 30%. Surcharge has been added recently, but otherwise it is not that much. But in your case, you do have to pay. And now, please, I'm coming to that. This is the story. Now, since you are a citizen of US or holding green card, you have to declare the complete income. You have to pay tax in foreign country. You have to pay in US to pay. You have to pay. I know that. Global income. But wait. Since if you have applied a tiebreaker, or if without tiebreaker also you are non-resident of India, if you are without tiebreaker also non-resident, or after tiebreaker you become non-resident, look here. The dividend which you receive, now the dividend in the case of an Indian company, if they declare dividend, domestic company, it is now taxable in the hands of the recipient. Earlier, dividend tax was paid by the company. We used to call it dividend distribution tax up to 31st March 2020. But after 31st March 2020, if a domestic company declares any dividend, the dividend is taxable in India at the slab rate, whatever is your slab, whatever is the slab. But wait, in case of a non-resident, the dividend is taxable. Under section 115A at 20%. If you don't apply the treaty, at 20%. But if you apply the Treaty of Indo-US, then the rate is 25%. It is 25%. But we have the law. You have to apply, if you have find beneficial law for income tax, you don't apply the treaty. You can pay 20%. But wait, in 20% you have to include surcharge. We have a surcharge of 10% if your income is above 50 lakh. If we have a surcharge of 15% if your income is above 1 crore. Indian income, not foreign income, Indian income, because you are non-resident. If that is about that, then only surcharge. Otherwise, 20% as per section 115A, whereas I look your treaty, it is 25%. Yes, if a US company has invested in India and they are holding 10% voting power in Indian company, then treaty says 15% rate of tax. So company can take a benefit at the rate of 15% tax if the treaty, but if you are individual, the tax in US, tax as per treaty is 25% dividend. If you are non-resident in India, 25%. But our law says pay 20% plus surcharge plus education, says you have no problem. We don't want, you don't go to treaty, don't go. So this is dividend. Because the question was, when I receive dividend from Indian company, how will that dividend be taxed? I've told you, dividend in India is taxed now in the hands of the recipient. But whatever tax you have paid in India, whether 20% or 25%, you will get credit in US. You will get credit in US while paying the tax on global income. Because in US, your dividend will also be included, but you will get the credit of whatever tax you have paid in India, whether at the rate of 20 or 25. I said, why 20? Because by including surcharge, it can go beyond 20 also. At times, if you are more than 2 crore or 5 crore. But if you are less than that, that 115A is beneficial. But you get credit of that. Similarly, the interest income which you earn from India, I'm not talking about non-resident external, it is exempt. Interest income, well, it will be taxed in India. It will be taxed in India if you have given that loan in foreign currency at the rate of 20%. If you have given loan. But if you go for treaty, the treaty rate is 15%. So you can always, in treaty, there is no surcharge, no education tax. You can always pay tax in India if you are non-resident at the rate of 15%. And you can get the credit of 15% in US by giving the tax on global income. You will get the credit for that also. So there is absolutely no worry. So let me tell you, for interest, for royalty, for fee, for technical services also, we have a system of taxing the income at 10%. So why do you take the treaty benefit? Treaty is only 15 and 20%. But in India, you pay on royalty fee for technical services only 10%. A non-resident, if he pays 10%, he gets the credit of that person in that country also. So there is absolutely nothing to worry. So what I'm trying to explain, even if you come to India for more than, for 120 days or more, but up to 181 days, you become resident, but not ordinary resident. But by applying a treaty, you can become non-resident. And if you come here for 182 days and you are also resident of that country and you apply treaty, you become non-resident of this country. Somebody asked me, Rule 120 of US. In US, if you are there in the previous, in the year, current year, 31 days, and in the 3 years, including the current year, for 183 days, 182 days, I say I'm not wrong, you become resident. But while calculating 182 days, current year you have to calculate full. But 1 year before, you have to take it 1/3 of the total stay. And 2 years before, you have to take 1/6 of the total stay. I give the example. Suppose you were in US for 120 days and each 3 years. For past 3 years, you are for 120 days each year. Current year 120, last year 120, previous year also to that is 120. What happens is current year 120, okay. Last year 120 divided by 1/3, you will take 40. So 120 plus 40, 160. Then second year 120 divided by 6, it becomes 20. So 180. Since it is 180, it is less than 182 days. You are non-resident. You are non-resident of US. You are not. But maybe you are non-resident. if you are a citizen, if you are holding green card, come what may, you have to pay tax on the global income in USA. I have superficial knowledge of US, but somehow or other, whatever I could understand, I have told you about that knowledge of, and you get a credit of only federal income tax. Please, you get a credit of only federal income tax. You don't get a credit of state income tax, or you don't get a credit of accumulated earning tax. You don't get a credit of social security tax. It is only federal income tax which you have paid in US. You get a credit in India. And in India, whatever tax you have paid there, you get a credit there, including whatever paid tax there, including surcharge, including surcharge also, you get a credit in US country. So that point is also maybe kept in mind, that you have a benefit of that. I'm coming to two more points before you can. One is, the question was very specifically asked, dividend I've told you. What about if I have a property situated in India, or immovable property situated in India, I want to sell that property and there is a capital gain, where the capital gain will be taxable. Wait a minute. In the treaty also we have said that capital gain will be taxable as per the domestic law of each contracting state. Each contracting state. That means if you have a capital gain in India, we will apply the Indian law. If you have a capital gain in US, we will apply the US law as each contracting state. Now, if you sell a property in India, immovable property first I take, and it is long-term capital gain. That means you sell it after 2 years of acquisition. There is a long-term capital gain. It is taxable at the rate of 20% plus surcharge plus education cess. But wait, before you tax it 20%, we give you the benefit of indexation also. Indexation is the benefit of the cost of living index. You get a benefit of that. Because if you had got a property before 2001, 1st April 2001, you are given a liberty to take the market value of that property on 1st April 2001 and take the base year as 100 of 2001. And then up to last year, you could index it by multiplying by 289 divided by 100. So you are given cost of living index benefit also. Index benefit is because of the inflation. That is inflation index benefit. So if you have property bought, let's say before 2001 for let's say 50 lakh, and on 2001, the market value was, let's say, 1 crore. And if you want to sell that, your cost will be 1 crore multiplied by 289 divided by 100, 2 crore 89 lakh. This is last year, because current year index has not come. 2 crore 89 lakh. Suppose you have sold it for 5 crore. The capital gain will be 2 crore 11 lakh. Am I right? 2 crore 11 lakh, because 2 crore 89 will be cost, index cost of acquisition. 2 crore 89 lakh. So 2 crore 10 lakh, you will have to pay tax in India at the rate of 20% plus surcharge plus education cess. Now, the resident who buys the property from you will deduct the TDS at this rate on the gross consideration price. Please, he will deduct TDS on 5 crore. How does he know what is your capital gain? You have two alternatives in that case. Either you go under section 195(2) and tell the AO of India to reduce this, because my capital gain comes out to this amount, because calculation will be given by you that it is not 5 crore, it is 2 crore 80 lakh. Give me that relief. Then he can deduct tax only on 2 crore 19 lakh, 2 crore 11 lakh. But suppose 195(2) you don't want to go. But if not, if you have bought the property before, after 2001, then there is no problem, because you don't have to assume fair market value on 2001. Then you can index yourself and they can deduct tax only on the capital gain. Whatever tax you have paid in India on this capital gain, don't worry, this income will also be included in your income of US, but you will get the credit. Whatever you have got paid in India, you will get credit there. This is for capital gain also. You have immovable property situated in India. The rent from that immovable property will be taxable in India, obviously, at the slab rate. Let me tell you, for non-resident, the slab rate is exemption is rupees 2,50,000. 2,50,000. And beyond 2,50,000, you have to pay tax on the next 2,50,000, 5%. On the next 5 lakh, 20%. On about 10 lakh, 30%. And if you have more than 50 lakh income, then surcharge 10%. If you have more than 1 crore income, surcharge 15%. I'm taking up to this only. I don't want to confuse you a lot, but whatever I could gather, I have told you. You want me to talk about any other point, I can talk to you. Otherwise, most welcome to take any number of questions you want.
Yeah.
Up to you.
Yeah, Dr. Ahuja, I'll just wrap up a few things for the listeners in US, basically to cover the US standpoint, and then we'll come to the questions. So basically, as far as the residential status, as Dr. Ahuja mentioned in US, it's basically if you are a green card holder or a citizen, then you have to pay tax on global income.
Yeah.
No matter where you live. But there is the second is the substantial presence test, which he mentioned. It's 183 days in the current year, or 31 days in the current year, plus 1/3 in the previous year, and 1/6 in the second year before. Then there are special rules in the case of dual status resident. When people come in a particular year, then they file returns as a dual status resident. In the year they get green card, or they become they move here permanently, or they leave the green card, they quit the green card and go permanently to India. So there are special rules. A dual status return can be filed. Certain categories are exempt in this, which is F1 students. They are still considered, even if they are here 365 days, they are considered students, J visa holder, M visa holder, or Q visa holder. And for this year, they have given special exemption for the US residents because of the COVID-19 situation. About 60 days exemption is there for the US residents purposes. And
that has been given in India also, sir.
Yeah. And
but one thing, professors and teachers also, if they stay there for 2 years, that also is not taxable.
They are exempt if they are coming on J1 visa or F1 visas.
Correct.
Yeah. So, it becomes an interesting situation. The year they change from F1 to H1, then we have basically a choice to do it. Many times we calculate the number of days. There are both the options. They can even tax themselves as resident if they include India income, get a credit. Probably sometimes tax is lower, because as a merit here in US there's a concept of merit filing joint also. Whereas when you, dual status residence return, then you cannot do a joint return. Then it has to be single return only as a merit filing separate. And then you don't get the benefit of a double exemption based on your spouse. And with the other second point, which Dr. Ahuja mentioned, was the abolition of dividend distribution tax. On the face of it, it sounds as if now we have to pay tax in India on the dividends. But actually, it's a credit, because you are getting you can also claim a credit on foreign tax, which earlier was not available.
Sir, can I come in too?
Yeah, sure.
This has been done, especially we recommended this, that foreign investors are not interested in coming investing in Indian companies, because dividend distribution tax is paid by the company and it is not paid by the recipient, and they don't get credit in country. So this thing to the government, let the tax be paid by the recipient. Because if it is paid by the recipient will get credit of the tax paid in India in foreign country. That means in US. Earlier they were not. That was the reason for bringing this change in the law. Yes, sir. Please continue.
Yeah, now the next actually point is on this capital gains on the sale of property or investments in India. So here I would like to invite you once again to talk a little more about some of the tax saving options which are there. The reason I am saying is because what we see here is people come here in the US, they come, okay, I've already sold the property in India, I've put it in REC bonds, and I'm not taxable over there. What should I do here? So we basically have to balance in the some of the tax saving options in India, and then in the US also there are a couple of options. So I would like you to first mention the options in India for the, let's say the property is sold by somebody.
I did not mention it intentionally. I'll come back.
I'll tell, because this is where we have a lot of people who are, it's on a daily basis. People sell the property there. They say, okay, I have invested in the bonds, or I have done some tax saving. So now I shouldn't be paying. Now what happens is they end up paying tax in the US. So on the one hand, they have blocked the money over there. On the other hand, they have to pay tax in the US also. So it's
correct. Correct. Let me tell you the law of India.
Yeah.
We have two sections called, one section is called as 54 section, another is called as 54 F section. What does 654 section says? Where there is a long-term capital gain, long-term means you sell it after 2 years, immovable property, from the transfer of any residential house property by an individual or HUF, that capital gain shall be exempt to the extent it is invested in the purchase of another residential house property within 1 year before or 2 years after the date of transfer, or in the construction of a new residential house property within 3 years after the date of such transfer. Wait, what I'm saying. You sell a house property, residential house property after 2 years. You are an individual. Now you have sold it for 5 crores. There is a capital gain, let's say, of 3 crore. 2 crore is the cost to 3 crore. The entire 3 crore can be taken as exempt in India if you invest that 3 crore in a house property, residential house property. You can buy beforehand also, 1 year before or 2 years after the date of such transfer. Or you construct a residential house property within 3 years. Your entire capital gain in India will be exempt. But what will happen of that? You are liable to pay tax in foreign country, US, because they don't give you that exemption. That exemption is only in India. There is a second case also. You sell anything in India, long-term capital gain. Sell anything. And you earn, suppose you have sold it for the shares for 3 crores rupees. You have sold share of India. You invest this 3 crore in the residential house property within 1 year before or 2 years after, or construction. The entire capital gain on this 3 crore will be exempt. But now you have to weigh that. You have to weigh that if it is exempt, what is going to be there? You will be taxed there. Secondly, if the capital gain is only 50 lakh, then we have a system of investing in National Highway Authority bonds or rural infrastructure bond, where you get an interest of 5.5% per annum, 5.5%. But that is taxable. But you have taken the exemption of capital gain of 50 lakh. That 50 lakh will not be allowed. And these days, they are not giving benefit to this also to non-resident for 54 EC. These days, they are not giving. Earlier, they were giving. But still, I'm telling you, be careful. You have taken an exemption in this country, but wait, that amount will be taxable. That Mr. Bhatia will tell you how that is taxed in the US. Thank you.
Yeah, so now coming to the, as Dr. Ahuja mentioned about the tax, some of the tax saving options in India, but we have to do on a parallel calculation in the US. So couple of things which we need to keep in mind here. First of all, in US, there is no indexation, so as Dr. Ahuja mentioned. But what indirectly what we can take is we can take an advantage of a foreign currency difference. So if, let's say in 2006 the dollar rate was $40, today it's 78 or 77. So we have almost a 200% or 180, 190% indexation. So that leverage can be taken. So cost will be taken at $40 and sale price will be at 78. So that indirectly that advantage comes a little bit of the inflation, at least in the currency devaluation. Then there is one more exemption, which if it's in the case of sale of residential property, if somebody, a US citizen is living in India or a green card holder is living for longer duration over there and he has a house property over there. In US, you have an exemption if you live in any house for at least 2 years during the last 5 years, again up to 500,000 can be exempt in the case of joint return and $250,000 in the case of single return. That exemption will be available even if you are living in India for a longer duration and using it as a primary home. So this factor also has to be taken into account. Thirdly, if you have an inherited property, now that's where, again, there is an advantage in the US as compared to India. The moment if you inherit the property, the cost of the property is taken as the stepped up basis at fair market value. The reason is in US we still have estate duty, which India abolished the estate tax long time back in 80s.
85.
85, yeah. So in US it is not. So because there is only an estate tax given, although the exemption limit is at 11 million per individual, but still because of that, the cost in the case of inherited property is taken at the stepped up basis, which is the fair value at the time of death of the person. And so basically that advantage is there in US, not in India. Then another interesting concept could be in some states which follow the community property, like California and New York. Even if one spouse dies and it's a community property, the basis is stepped up for the entire property in the US. So in those cases, the advantage of India and the US both have to be balanced, because maybe in such cases, investing in some tax saving bonds could be an advantage. And there is one more thing which we can take in the case is where if it's a rental property you have in India, and you're using those advantages, there is something called a 1031 exchange, where an investment property is reinvested in another investment property, or a rental property is invested in another rental property. You can do a 1031 exchange and defer the tax. In India, probably in many cases you are completely avoiding the tax. Here you are deferring the tax, but then it has to be a property outside US, not in you can't sell a property in India and a rental property in India and buy a rental property in US. So these are some of the things which are to be taken into consideration. And of course, the tax rate for capital gains is starts at long-term capital gain is for single it is exempt till 40,000, and for married filing joint up to 80,000 is exempt. And between 40,000 and this is for 2020 rates, because it gets adjusted for inflation every year. And for single from 40,000 to 441,000, it's in 15% bracket. For married filing joint, it is 80,000 to 496,000, close to 500,000. It's in 15% bracket, and it's 20% beyond that. So these are some of the factors. Of balancing has to be done between India tax and US. And of course, you can get a credit only for the federal tax, not the state tax or any local tax. So obviously, because generally what happens is somebody walks in, he says, okay, I'm selling the property. My friend did this, should I do the same thing? Every case, every factor is different. Everyone has their own factors, circumstances, and those need to be balanced both in US and India terms. So, and one more factor which comes in is the remittance of fund from India. That really is an issue, because everyone asks. Then they are paying tax in India, and then they after that they want the money to be transferred from India to the US. They need to get a certificate from a chartered accountant in Form 15CB, and another Form 15CA has to be submitted to the tax department. And so those things have to be taken into consideration.
Sir, but you are allowed to take $1 million every year.
Yeah.
Baki, taking a 50 CB is not a very big thing.
Right. That's correct. But again, they have to be. It has to be tax paid many times.
It's all online business
filing
now in India.
Yeah, but many times they are not filing the return. They just get some deposits and all that. So those factors are there. So somewhere they have to establish before a CA also. So I had a question, sir, Dr. Ahuja. If somebody is selling a property and it's actually selling at a loss, does he still have to, will there be a TDS still to be deducted, or there can be an exemption in that case?
Point is, there are two ways. If you have bought a property after 2001, then you can, and you have not done any improvement, a cost is there, then you can index that and then calculate the capital gain or loss. No problem, no TDS, because working can be there, because your registration deed will show how much is the cost. But if you have bought property before 2001, because you are allowed to opt for 2001 market value, and how correct it is that you are opting for market value is correct, and then you have to index it. So therefore they don't allow you. Then in that case, we have a section 195(2), you have to make an application to the AO online these days, of course, and you will have to give all those calculations to him, and he will give you a certificate for tax to be deducted at lower rate. Absolutely no problem. 195.2 is there. And we have also one application in Form 30. We call it Section 197, where you can tell them to take a certificate from AO for deduction of tax at lower rate. So there are two ways. Yes, somebody, you will have to take a help of someone. You can have to take a help of someone. Now Mr. Bhatia is there and his brother is in India. He can always take a benefit of that. And you can always do that. And you can go apply for that through that, and you can get a benefit. Let me tell you, it is possible. Otherwise, if it is after 2001, there is no problem. Even if there is a capital loss, no need to deduct TDS. But working should be very correct. Otherwise, you will be held responsible. The Indian citizen will be held responsible for not deducting the tax. So that is the issue which I wanted to tell you.
So in this case, who will be applying to the AO?
195.2, the local man can apply. But 130, Form 13, well, 197, the non-resident has to.
Right.
In 195.2, the local man can apply by taking details from you.
Mm-hmm.
But normally he doesn't want to do it. He said, why should I take the trouble? I will deduct the TDS and my job is over. But if you have something, it can be done. But let me tell you, the property which have been acquired after 2001, where the cost is known, you are not allowed to opt for market value, and you have not done any improvement, you can certainly index yourself and calculate tax. And if there is a loss, no TDS. If there is an income, you can deduct TDS only on that capital gain, not on the total amount.
Okay, so now we don't have too much time. I think we can just quickly touch upon one or two things. There is another change called equalization levy. Just briefly, you can tell. This is equivalent to something we have in the US last year, which is
we have done equalization levy 2 years back, but this is another one. Now there are two types of equalization levy we have in India. First thing, if a resident of India has taken any advertisement, done any advertisement in the foreign place on online advertisement, or taken any digital space of a non-resident online portal, he has taken an advertisement space, or he has advertised there, or taken a digital place for advertisement. They're like Google, if you have taken. Now, if that amount exceeds 1 lakh in India, he has to deduct 6% as equalization levy while making the payment to Google or any other portal there outside India. 6% equalization levy he has to pay. But if now most of the time I've seen, they don't pay. They said, we are not concerned. We will charge only let's say $50,000, but we are not going to give the tax to you. Then in that case, the TDS will be deposited by the Indian resident from his own pocket. But by doing that, he'll have to gross up the amount. That, on 100, you have paid 6. So you will calculate not on 100, you will gross up the amount and then calculate 6%. That the duty of the resident of India who has made a payment of exceeding 1 lakh to outside India, and that advertisement is for business purposes. And that portal which is outside India does not have permanent establishment in India. If they have permanent establishment in India, there is no problem. If they don't have permanent establishment in India, then we are under an obligation to deduct TDS at the rate of 6% while making the payment. And if I do from my own pocket, grossing up of that. Coming to the new one, e-commerce operator, a non-resident e-commerce operator sitting in US. Now, if he makes a supply, e-commerce supply or render services, or he facilitates the e-commerce supply or services to a resident in India, the service is made to a resident in India, then e-commerce operator sitting there abroad, non-resident, will have to pay equalization levy at the rate of 2%. 2%, provided his total turnover exceeds 2 crore. 2% of the gross amount. that if there is an e-commerce portal outside India, let's say Amazon outside India, not in India, outside India. You know, you have two types of portal. One is called Indian portal, another is called foreign portal. Indian portal is always, we start with IN. And in the foreign portal, we have Amazon.com. But in India, we have Amazon.in. Whatever I'm saying. If you are using a foreign portal, e-commerce operator supplying to any resident in India goods or services, e-commerce operator will have to pay tax at 2% in India. Quarterly to be paid. If the total turnover exceeds 2 crore. Second, total turnover of the whole business of the e-commerce operator, not only for this. Or he renders certain specified services to non-resident there. Then also here. Or he supply goods to any person, but that person has used Indian portal address. Then in that case, also e-commerce operator will have to pay 2% equalization levy with effect from 1/4/2020. So if, let's say, Messi, they are a storehouse, they have also e-commerce, let's say, portal. And if I place an order on Messi, turnover of Messi is definitely more than 2 crore, there's absolutely nothing. If I place an order to the Messi, for Messi product, Messi supplies me. Now, the Messi will have to pay 2% on the value, consideration received from me. 2% will have to pay in India. But suppose Messi there is marketing other product also, of other persons also. Then he is facilitating that portal. He is facilitating the portal of supply of goods or services. Then whenever payment is made to the Messi will charge some commission, or on commission they will have to pay 2%. But suppose I advertise in India at Messi portal there, and I place an order by using internet of the India, then in that case, Messi will have to pay tax on the commission which they charge at the rate of 2%. It's a new concept which has come. One was TDS deducted if I give advertisement in a foreign portal. That is 6% we started 2 years back, rather 3 years back, 2016. Maybe you copied from us, sir, because we started this equalization from 2016 and not 18. But this has been started today of e-commerce operator who are non-resident e-commerce operator. If he's a resident e-commerce, now look here, one more thing. If e-commerce operator is making a payment to e-commerce participant of a resident of India, please, let's say I have a company, I have advertised in the portal of what you call Amazon US. Amazon US, somebody placed the order, Amazon US. They placed the order, but it is using my portal. Order is given there. Look here, they will have to deduct even the payment which is made to me, a tax under Indian law, TDS, under section 194O, while making a payment by e-commerce operator who is outside India. If he makes a payment to e-commerce participant in India, it will become his duty to deduct the TDS at the rate of 2% and deposit with the central government of India. Please, first time, 204 section, where a non-resident has been, it has been responsible for deducting the tax on payment made to e-commerce participant in India. It's a new thing which I'm telling you. First time it has happened that if you are in US, e-commerce operator, you are making a payment because it is sold through you. You are making a payment to e-commerce participant in India. So in that case, whatever payment you made, 2% of, sorry, not 2%. 1% of will be deducted as TDS by e-commerce operator there and deposit in India, either himself or through agent in India. It's a new concept, 194. I'm not talking about the another concept of equalization levy. Equalization is he has to pay tax in India at the rate of 2%. This is Indian payment made to Indian participant, e-commerce participant. He will deduct tax at 1% and deposit in India. So these are the two amendments. One I've told you about equalization levy. Another I've told you e-commerce operator non-resident making payment to e-commerce participant in India. In India, my product sold by him or facilitated by him, he makes a payment to me. He makes a payment to me. You may say, no, he doesn't make a payment to me. I get a payment directly from purchaser. Still, that amount will be included and he will have to deduct TDS at the rate of 1%. A new concept has come. It's a very difficult concept, but I have tried to make it as simple as I can.
So this actually, in the US, this whole fight used to be for the state's autonomy issue. So in 2018, there was a case, South Dakota versus Wayfair, where Supreme Court actually overruled the defense of commerce clause and the due process clause in the US. And after that, basically it was like the states could not tax an out-of-state entity in that state. But in this case, it was like a historic judgment. It was overruled, and the Supreme Court ruled that the physical presence rule is not a necessary interpretation of the requirement that a state tax must be applied to an activity with a substantial nexus with the taxing state. So in this case, basically, the South Dakota was imposing tax on sales made in their state by outside state sellers. So now most of the states have started following this and started imposing tax on the sales which are made within the state. So as a next corollary to this, everyone has started coming with a new concept which is called a market facilitator concept. And pretty much the market facilitator is the definition very much like what India we are pursuing. Anybody, Dr. Ahuja was mentioning about India. Basically, anybody who is transmitting or otherwise communicating through any online portal, through any electronic portal, or using providing a virtual currency for transaction or payment processing service, or any software development or R&D activity which is related to payment processing, or any fulfillment of storage, or order procuring, or listing of the product for sale, basically setting up prices, order taking, all these, or any branding of a sale, all these are called market facilitators. And they are, let's say in California, they have put a 500,000 threshold. So anybody crossing the threshold has to pay tax. So basically what they have done is they have shifted the onus from marketplace seller to a marketplace facilitator. So anybody, even though you are holding a portal which is just facilitating a transaction through your portal, even if the purchase and sale is not made by you or you're just getting a commission, the onus has been put on you if you fall within that definition of the marketplace facilitator. This is the change from 2019, October 2019. So one question I had, Dr. Ahuja, there is also now a new concept of
Neeraj, can I interject?
collection on, yeah.
Sorry about that. We have to be mindful of the time as well.
Yeah, so I think it's a quick one or two questions, and then we can go into the thing. There is one more new. Yeah, it's on tax collection and source on remittance, because that's another thing people maybe want if they have to get money.
But that is only for resident. No. Resident sending money under liberated scheme, not non-resident. My scheme is only for
collection, TCS, the deduction of TCS.
I think there's
no TCS. It is liberalized remittance scheme for resident. If I send money to US for education my children, I send money. Money. And if it is more than 7 lakh in a year, now while sending the money, they will deduct they will collect 5%. 5% of the amount sent by me, not for non-resident. It is only for resident sending money outside India, which I am allowed to send up to $250,000 per year under liberalized remittance scheme. So if I send for children education, then they have given one concession. If I borrowed the money from financial institution for education of my children out, then the TCS is not 5%, it is 0.5%. 0.5. The TCS I'll get credit in India, but that is only resident sending money,
So
not non-resident.
Here moves to India with that 120 days or 180 days rule, and he sends money to US, he will have to pay the tax on the remittance. Then that status change has an implication there.
That is. But once you come to India, non-resident external account, if you have to come and stay here for unspecified period, then non-resident external account has to be converted into NFC.
Right.
RFC rather, rupee, what you call resident financial currency account, foreign currency account. Resident foreign currency account, which is taxable. Let me tell you.
Right. Okay, now we've got some questions. We received a few questions beforehand, so let me just read those out. First question was how to save tax on long-term capital gain on sale of residential property and how much.
Explained, sir.
Yes. Yeah, we've already done that.
You have also explained.
Yeah, right.
I have added to my knowledge a lot of things.
Are there changes applicable to US citizens too? I guess it's the same as so basically
you have already answered, sir. You have already answered.
Right. Then what about, there's one question, Setu is asking details of FBAR FATCA. This is basically, I would just summarize that there are options available. Basically, if somebody has not been filing, they need to come through a streamlined process, which is open. We will not have much time to go through the detail. And Mr. Basant Kumar Dugar asked, do US-India tax treaties having any tax, I think he meant foreign tax credit, probably this is on interest, dividend, profits, etc. I think
I've told you.
Yeah, there are tax, I think you covered already. Mr. Vidi Gri is asking, hello, can you please cover India tax for resident OCIs for their US income? If I become a resident in India in 2020, so will there be any tax in India? So I think that also you've covered.
Yeah.
Right. Next, Mahesh Kumar, he has a question on repatriation of funds to US from sale of inherited property in India. I think this also we covered.
You have explained that.
Yeah. Then Mr. Sachin Agrawal has a question. How is withdrawal of PF due to relocation treated per tax laws in India and US?
If you relocate after 5 years, there is absolutely no problem. After 5 years. But if before 5 years, there is a system where you can get exemption also for, because if you are for a fixed period of time, if you are here for a fixed period of time, in that case also, if your period was 3 years or 4 years, that year also it is exempt. But if you are not here for a fixed period of time, then in case after 5 year withdrawal is fully exempt. But before 5 years, it is taxable.
So, and from the US standpoint, I think we need to be careful in calculating this, basically whether we are reporting income year-wise, because if we do not do it, there is a chance that the moment we get the remittance, it is in cash the entire period from the maybe taxed. So it's best to report some income or the gain year-wise it is due from the time somebody moves to US.
Right.
Next question, Anil Kumar. I'm a US citizen, so do I have to file tax return in India? I think that depends upon, I think, the income threshold.
If your income is about 250,000, you are supposed to file.
Yeah. Manikam from Manikam Coimbatore, he's asking, what if my investments in India have breached the FBAR and FATCA limits and I have failed to report in US?
He's in India, he can ask me anytime later.
Yeah. No, I think that's his name. He's here.
You said Coimbatore.
I think that probably is his last name. I'm not sure.
Okay.
Yeah, so I think he's asking, so if they have breached, I think the options are to go through a streamlined process. It's a whole new subject, which we can cover sometimes later. And I'll pass on to Geeta. There are some questions which are there, I think, in the chat window also.
Yes, thank you very much, Neeraj. Actually, many of these have already been answered, but there's a lot of questions around interest income from banks. Can we take credit for TDS that has already been deducted, and what kind of forms should we get from the banks? Is that something?
Yes. Yeah, we can get a foreign tax credit on the interest which we are paying in India, and normally we use the form 16 which the banks are issued. We calculate depending.
16A. We call it 16A.
16A. Yeah.
Excellent.
Form 16A.
Excellent. Thank you. The next.
And we have 26 AS. We have 26 AS form also, which can be downloaded, and there the whole details are there. You can download for your registered portal of India. You download it 26 AS. That also gives you the credit for that.
So you don't have to rely on the bank. You can actually download it yourself from.
But correct.
But there's a rider, I'll tell you, if those individuals are also filing return in India and claiming the refund back over there, then they should not be claiming.
Yeah, that point is to be
done. Yeah, or
only to that extent they will not be able to get it.
Correct. And or at the time of filing the return, they still are paying more tax. They can get a credit for the additional taxes.
The better is the copy of the income tax return also.
Right. Yeah.
Correct.
Thank you. Shweta Sagar has a question on capital gains. She has paid capital gains tax in India, and she is asking if we can claim credit. I think we went over that. I'm not entirely sure if it's movable or immovable properties, but I believe that movable properties we went
doesn't
over.
make any difference.
Yeah.
Yeah. Okay.
In both the cases, we can.
Both the cases we can claim tax credit. Indexation benefits are available in India, and you were talking about the foreign currency forex
differential. Yeah,
correct. The only thing I'll tell you, the foreign tax credit in US is calculated in different buckets. One is separate for active income, like if somebody is working, also getting any salary, working in India, getting salary income or business income. And the other is the passive income, which includes interest, dividend, rental income, or capital gains. So those are the buckets cannot be mixed, but they can be claimed.
They can be claimed even if
Yes.
they've already been paid. It's not. Yeah.
Correct.
Okay.
Yeah, you can get a credit for the tax paid in India.
That I think that answers the question. I'm just scanning through my questions. Can you apply the treaty rate for some sources of income and the Indian Income Tax Act for other sources of income in the same investment year?
Yes, you can do it.
Okay, excellent.
You can do it. Yes, you are allowed.
Okay, thank you. I think that about summarizes the questions that we have. I think most of the others have been answered. And I guess not a minute too soon. Anurag, how are we doing on time?
I think we are just dot on time. Just 2 minutes is not. We're just 2 minutes over. So I think with that, Neeraj, if you have,
No, I think I would like to thank Dr. Ahuja for giving his valuable time. I know he's been extremely busy, but just quick as a wrap-up question. Now how do we see, one question I've been curious to ask, since you've been part of the drafting the Tax Act, what are we hearing about in terms of ease of doing business? Because a lot of difficulty is faced by the foreign investors in terms of setting up ventures.
We have given lot of advantage in FDI is now automatic route. They can come 100% automatic route. Also, the FDI people can come and they can invest in Indian shares, in bonds and all those things. We have given the benefit to the FPI also to invest more than 10% also there. We have been giving benefit, but at the same time, let me tell you, there are all types of people, all types of people. People have shifted from India and gone abroad just for a different reason. You understand what I'm saying? Money laundering, they have taken the money in wrong means. They don't want to give the details of the foreign because of Black Money Act which came in 2015. Now they don't want to give the details of the foreign income. They have not given amnesty scheme. They did not avail. So they said, let me become non-resident. And once I am non-resident,
so yeah,
then they will not become non-resident. And because of that non-resident, we had to not come to India for more than 119 days. Because people, Indians are very clever. Let me tell you, they have mind to apply. They are really mind to apply. They can do anything. One joke, all the last minute I can tell you, and then we will close. 4 chartered accountants and 4 engineers were traveling the train. When you meet in the train, you start talking to each other very smooth. So the engineer, chartered accountant, who are you, sir? We are engineers. And engineer, who are you, sir? We are chartered. Oh, you are chartered accountant? You must have done planning. You do planning. He said, yes, we do planning every time. Now, what is the planning you have done today? Sir, we have taken only 1 ticket. We are 4 chartered accountants, taken 1 ticket. How it is possible? We said, wait and watch. The TT comes, all the chartered accountants go to one toilet. He knocks at the door, one hand comes out, he shows the ticket, and he walks away. And then the engineers were really sorry. What kind of a planning you have done? Wonderful. Then again met, they were traveling from Mumbai to Pune. This time engineers are also very happy. What happened? Sir, we have also taken one ticket this time. How many tickets you have taken? Sir, we have not taken any ticket. How it is possible? He said, wait and watch. The TT comes. 4 chartered go to one toilet, 4 engineers go to another toilet. One chartered comes out, knocks at the door of the engineer, ticket please, and takes the ticket and goes to his toilet. What a planning they have done. Again, they again meet in Bombay. Now traveling from Andheri to Churchgate in a local train. Again, they said, no, we don't want to talk to you now because you are always putting us into difficulty. Engineer said, how many tickets you have taken? He answered, 1 ticket. Engineer said, sir, how many tickets you have taken, chartered account? Sir, we have taken 4 tickets. What is this? One time you took 1, now 0. Now you have taken 4 tickets. What is the reason? He says, wait and watch. The TT comes. The engineers are looking for a toilet. There is no toilet in the local train, let me tell you, in India. So therefore, you have to apply your mind. And people in India do apply their mind. And they have mind to apply. So just a joke, it is also an anecdote. Please don't take it seriously. I just want you to leave on a happy note. Thank you very much, please.
Thank you, Dr. Ahuja, for giving your valuable time at this busy hour. And I want to thank both on behalf of the Institute of Chartered Accountants San Francisco chapter, as well as on behalf of Indo-American Chamber of Commerce, and also all the participants who have taken their valuable time at the evening hour. It must be dinner time for people in US and very early on in India. So, but we had to balance out the time for convenience of everyone. So look forward to seeing you again soon. Thank you so much.
Thank you.
Thank you very much.
Thank you. Please take care.
Thank you.
Thank you. Thank you very much. Thank you, everyone.
Thank you.
Yeah.
All the
Good
best.
night.
Take care, sir. Take
Bye.
care. Thank you.